Morning class. This is SFM, Strategic Financial Management, Bond Valuation. A business is financed from two ways. Business is financed from two ways. One is equity and debt. So the equity talks about raising finance through the issue of shares, and we have talked about this. So under the equity here, we dealt with the right issues. So we are done with right issue. Now we are on debt. Debt. And one of the means through which a fund is raised through debt is to issue bond. And when you want to issue bond, you have to do bond valuation to know how much the bond holders will pay when you as an organization issue bond to raise finance. Now, let's see now. These are the basic features of bond. One is face value or nominal value or par value. When you say face value, that is the original price of the bond. It could be 1,000 naira, or 100 naira. Exactly. Just like your shares, right? Your share has three prices too. Your share has the face value, the premium, and discount. So just like that too. So that is the face value, the original price of the bond. And it is on the face value that you pay coupon. So what is coupon? Coupon is the annual cash interest. Coupon is the annual cash interest that the bond holder receives. The bond holder are those that invest in the bond issued by an organization. So you pay coupon based on the bond. For instance, 5% bond. So the 5% is the coupon. That will be the 5% times the nominal value. You have 5 naira. That is the coupon. Coupon is the annual cash interest that the bond holder received. And coupon, please take note, is calculated based on the nominal value. Next is the market value. The market value is the price at which the bond is currently trading in the market. This is the price at which the bond is currently trading in the market. If I want to buy the bond in the market now, what is the value? So that is the market value. Please, there is a difference between the face value and market value. Just like your ordinary shares, you have the nominal price and the market price. Exactly. Next, redemption value. Redemption value. Now, this is the value that the bond holder will receive, after the maturity of the bond. For instance, 4 years bond. 4 years bond. So it means that for this 4 years bond, the bond holder will receive coupon for year 1, for year 2, for year 3, for year 4. In the last year too, the bond holder will receive its investment back, which is what the redemption value. And bond can be redeemed in 3 ways. In 3 ways, right? It could be at par, or at premium, or at discount. Okay. So our redemption value could either be at par, or at premium, or at discount. Now, in the question, you have to read very well. If it's at par, it means that the bond is redeemed at the nominal value. If it's at premium, it is redeemed at above the nominal value. If it's at discount, it is redeemed at below the nominal value. But if the question is silent, okay, about the redemption value of the bond, please take it as a rule that such bond is redeemed at par. Next, maturity date. This is the date, okay, that the bond becomes matured for repayment. For instance, you have invested in a 5 years bond, okay, 5 years bond. So for year 1, you have received your coupon, year 2 coupon, year 3 coupon, year 4 coupon, year 5 coupon. So year 5 is the date of what? Maturity, that you are going to recover back your investment. Next, now yield, okay, yield or yield to maturity. Out there, yield or yield to maturity. Now, this is the interest, okay, that is the returns that the bond holder expects to receive from the bond issuer. The yield is the returns that the bond holder expects to receive from the bond issuer. Out there, it could be 5%, it could be 4%. So, but that is the returns on the bond to the bond holder. But to the bond issuer, that yield is a cost to them. Okay, is a cost to the company that issues the bond, but a return to the bond holder. We are going to talk about this more in cost of capital. The last now is the issue price. The price at which the bond is issued now to the market. Okay, the price at which the bond is issued to the market. So these are the basic features about bond. Okay, the types of bond now. Okay, bond can be classified into 3. One is called redeemable bond, or you may say dated bond. This is a bond that has a redemption date. Instance, let's say 5 years bond, okay, 6 years bond, 2 years bond. A bond that has what? A redemption date. So next is convertible bond. This is the bond that gives the bond holder an option, okay, or right to convert its investment in the bond to the ordinary shares of the company. So we are coming to bond convertible valuation later. Next now is this now irredeemable bond. That is the bond without what? A redemption date. It is called undated bond. Undated bond. So it has no date of redemption. So these are the bond. Next now is bond valuation. Bond valuation. Bond valuation. What is bond valuation? Bond valuation is the process of determining the market price or the issue price of the bond. Okay, this the price the bond holder will pay if they are trying to invest in the bond. So that is bond valuation. And the price of a bond, okay, or value of a bond is the present value of the future cash flows. Out there, the price of a bond is the present value of the future cash flows. Please, we are talking about a dated or redeemable bond now. Now, there are 3 things here. One is the present value. 2, the future cash flows. And the future cash flows here includes the coupon, okay, the annual coupon that the bond holder will get, and the redemption what? Value. Redemption value. So these are the 2 cash flows in the bond. Now, when you get the 2 cash flows, all the coupon that the bondholder will get throughout the life of the bond with the redemption value, then bring it to present value. Okay, it will be discounted to get the price or the value of a bond. And to discount the cash flows, okay, it is through yield to maturity. Out there, that is, the cash flows of the bond will be discounted at what? Yield to maturity. So that is how to do bond valuation, right? The present value of the future cash flows, and the future cash flows here are the coupon and the redemption value. You are going to get the coupon, okay, for all the years of the bond, plus the redemption value in the last year. Discount them at what? At the yield or yield to maturity. You will have the price of the bond, what the bondholder will pay to invest in the bond. So that is that. Okay, bond valuation, that is getting the price of the bond, can be done in four ways. One is using yield to maturity, that is, bond valuation can be done with yield to maturity. 2, using market spot yield. 3, by what? Corporate bond value. This is the risk-free plus basis point out there, or using future rate of interest, okay, to determine the price of the bond. So it is on these 4 bases that bond valuation can be done. So I am going to start first now with the yield to maturity. That is bond valuation using yield to maturity. In this case, okay, it is very clear. Yield to maturity. Now, yield to maturity is the returns, okay, that the bondholder expects to receive from their investment on the bond. As well, it also represents the cost to the company that issues the bond. Now, when a bond is valued at yield to maturity, we are saying that the bondholder, okay, will keep the bond till the date of redemption. That is, if you are investing in a 5 years bond, okay, then you are going to keep the bond to the date of redemption, and one single return will be used to value the bond for all the old years of the bond. That is yield to maturity. Exactly. So let us take a work example now from the material and see how we can determine the price of the bond using yield to maturity. Now, okay, bond valuation. Exactly. Remember that bond valuation is the process of determining the price of the bond. That is, if an investor wants to invest in the bond today, how much am I going to pay as an investor investing in the bond? To get the price of the bond, then bond valuation must be done. And like I said earlier, that bond valuation can be done on 4 bases. 1, using yield to maturity. 2, using market spot yield or spot yield curve. 3, using corporate bond basis. That is the risk-free plus basis point. 4, using the forward rate. But we are going to base ourselves on the first, second, and third. If time permits, I will show us bond valuation using the forward rate. Exactly. Now back to this now, yield to maturity. Now, yield, like I said, is the returns that the bondholder expects to receive from the bond. So that is the percentage that the bond holder will collect before they can invest in the bond. So let's pick now from our material, okay, from the basic bond valuation material, and let's look at question 1A and 1B. 1A and 1B. Question 1A. 1A says, how much would an investor pay to purchase a bond today, which is redeemable in 4 years' time at par value of 100 naira, and pays an annual coupon of 10% on the par value? The required rate of return or yield for a bond in this kind of risk is 4%. Obviously, this is a dated bond or redeemable bond. Now, how much would an investor pay now today to purchase this bond? This bond is having 4 years life, 4 years, and it will be redeemed at par value. I told you earlier that bonds could be either 1,000 naira in unit or 100 naira in unit as the nominal value. Now, here too, the yield here is 4%. 4%. So you say, here you say, yeah. Let's see now, okay, the price that the investor will pay. Item, cash flow, the discount factor at what? You discount the bond at the yield. Okay, I told you that the bond valuation is the present value of the future cash flows. You are to discount it at the what? Yield. That is 4%. You have the PV. Now, it asks for year 1, year 2, year 3, year 4. So, year 1, you will get your coupon. Interest. Year 2, interest. Year 3, interest. Year 4 is what? Your interest plus what? Redemption value. Because in year 4, you are still going to get the interest and the amount you have invested. Here is the coupon. So the coupon, like I told us earlier, coupon is calculated on the nominal value. The coupon here is 10%. The bond pays 10% coupon at what? 100 naira nominal value. That is 10 naira. So year 1, you get 10 naira cash interest into your account. Year 2, 10 naira. Year 3, 10 naira. Year 4, you also get 10 naira plus the redemption value, making 110. So now, what is now the discount factor now? For year 1 is 0.9691615. Year 2 is 0.9246. Year 3 is 0.8890. Year 4 you have 0.8598. Okay, so 8548. 8548. This times this, this times this, this times this, you get the PV. So that is more 9.615 to 9.246. Today you have 8.89. This times 110. You have 94.03. So you add this together. Okay, you have 121.78. Is that right? So this is what the price of the bond or market value, okay, like of the bond. So this is what you will pay today as an investor if you are going to invest in this bond, and you will enjoy 10 naira coupon for year 1, year 2, year 3, even year 4. That is that. Now, 1B now. 1B, the same question. 1B says here, 1B here says, now, suppose all information is the same, okay, is the same thing, except that the yield or required rate of return is 6%. 1B is maintaining the same information as contained in 1A, except that in this case now the bondholder are clamoring, they are demanding, they are asking for 6% yield, okay, as returns and not 4%. So let's see now. If the yield now is 6%, what will be the price of the bond? The price, it is the right of the bondholder to state what they want. Yes. 1, 2, 3, 4. So the coupon is the same thing. Coupon has not changed. You have your interest in year 1, your interest in year 2, your interest, year 4, your interest plus your redemption value. Nothing has changed here except the yield. You have 10 naira, 10 naira, 10 naira, 110. So what is the discount factor now of the yield when it is 6%? So for year 1, 6% is what? Is 0.9434. 0.9434. Year 2, 0.8900. 0.8900. Year 3, okay, year 3, 0.8396. 0.8396. For year 4, the last year of the bond, the year of redemption, is 0.7921. 0.7921. So the same thing now, let's do the PV of the bond. 0.9434 times 10 for year 1. Here you have 9. You have 9.34. Sorry, 9.434 for year 2. 0.8900 times 10. You have here 8.9 for year 3. 0.8396 times 10 again. You have 8.396. The last year now, 0.7921 times 110. You have 87.131. So let's sum together. Plus 8.396 plus 8.9 plus 9.434. Here you have 113,861. This is the price of the bond. Now, you are asked to explain there in the same question, right? Explain the relationship between the price of the bond and the yield. Now, as we can see from this example, okay, that there is an indirect or inverse relationship, nexus, between the price of the bond and the yield. Let's see, under A, when the bondholder demands for 4%, okay, look at the bond price, they will pay this price. When they demand for higher percent, 6%, the bond price falls to this amount. So it shows that there is an indirect, okay, connection, link between the price of the bond and the yield. So the higher the yield, okay, the lower the price of the bond. The lower the yield, the higher the price of the bond. Please, you should know this from now, that there is an indirect relationship between the price of the bond and the yield. The higher the yield, the lower the price of the bond. The lower the yield, the higher the price of the bond. This can be explained, okay, through curve. Okay. Let me show us now here, just to show us here, through curve. Pause. Let me explain to us now. Now, there is an indirect relationship between the price of the bond and the yield as is there. Now, this is the graph, okay? When the price was 121.78, we had 4% yield. But when the price falls to this, the yield goes up. Exactly. So that is how to determine the relationship between the price of the bond and the yield. Okay, the price of the bond and the yield. Determination of yield to maturity. Remember that you cannot get the price of the bond without a yield. Sometimes, okay, you might be asked to find the yield, okay, of the bond. I can ask this many times. Now, to get the yield of the bond, okay, you need some cash flows, relevant cash flows that you need. One, the market value of the bond, okay, as an outflow in what? In year 0. Exactly. You will be given the market value of the bond. 2, coupon, okay, of the bond as an inflow. From what? From year 1 to redemption date. Third now, the redemption value of the bond, okay, as an inflow to, okay, on the what? Redemption date. Please don't forget that your bond could be redeemed either at par or premium or discount. Now, to get the yield, the YTM of the bond, you need these 3 cash flows. Exactly. And it is very simple. To get your YTM, right, okay, you are what? To do your IRR, your internal rate of returns. So your YTM is simply put your internal rate of return, which you all know. You are going to assume 2 yield, okay, 2 discount factor to get to NPV. One will give you negative NPV, other will give you positive NPV. You are to assume this by yourself in the exam. No exam will tell you what to use. Exactly. So let us take a question now, okay, to calculate the yield to maturity of the bond. However, to find the yield to maturity, in the question you must have the market value of the bond. You must what? Calculate your coupon and then know your what? Redemption value. Now, okay, question 6. A bond has a coupon of 5%, right? Redeemable, okay, redemption period of 2 years and a face value of 100 naira with market value of 98 naira. What is the yield to maturity? Like I told you earlier, that your YTM is simply your IRR. And I don't expect anybody at this level not to know what IRR is. No. Aha. You are going to what? Use 2 discount factor. Okay. Now, I am going to try first. Okay. Now, 4%. 4%. Let's say try 4%. I have my year, my item, my cash flow, my discount factor, okay, is what? 4%. Then the PV, exactly. The bond has 2 years, so year 1, year 2. Year 1 is the interest. Year 2, the interest too, plus what? Redemption value. What is the coupon here? Check here. It has 5%. I mean 5% coupon. So 5% of the nominal value, that is what? 5 naira. That is our coupon. Like I told you earlier, you calculate your coupon based on the nominal value. So here you get 5 naira, year 1. Year 2, you also get 5 naira, but plus your redemption value, that is 105. Out there, 105. Because the bond has 2 years. Excuse me, sorry. Okay. Year what? Year 0, abi? Year 1, year 2. Okay. Year 0 is what? Is the market. Is the year you are what? Making the investment. Okay. So what is the market value of the bond here? Is 98.26. Okay. Here you have 0. You have 98.26. Year 1 you have your interest. Year 2 your interest plus redemption value. Your 5 naira, your 105. So at what now? At 1.886, then 0.9246. So let us discount now. This times this, there you have 9.45. 9.45. This times this, you have 92.46. So these are the inflows. Now add this together and less this. Here you have 3.63. Exactly. Here you have what? A positive what? MPV. Okay, so to say. Now I need negative now. So I will now try higher what? Higher factor. Let's say 6%. If 4 can give me positive, to get negative, I have to use higher discount factor. So here, item, cash flow, and discount factor at 6%. Then my PV here 0, 1, 2. The market value of the bond here is still what? 98.26 as an outflow. Okay, because that is what you'll be paying to get the bond. It's an outflow. The interest year 1, year 2 interest plus redemption value. You still have 5% and 105, but at different discount rate now. So here I have now 1.833. I have 0.890. So this times this, okay, I have 9.165. This times this, I have 89. If you add this together and less this, you will have what? Negative 0.095. So now I have, 0.09 So now I have a negative and positive. Therefore, what is my IRR? Yeah, my YTM. My YTM equals my IRR. The lower rate plus what? MPV of lower rate plus MPV of lower rate plus what? MPV of higher rate into bracket higher rate and lower rate. Is that clear? So now, what is my lower rate here? Is the 4%. Okay. What is the MPV of it? 3.6, 3.63. Again, 3.63. 3.63 plus the MPV of the higher rate 0.095 out there. Then higher rate is what? 6 and lower rate 4. Then you have 4% plus 3.633 over what now? Over 3.63 plus 0.095. You have 3.725. 3.725 into 2. Please and please, okay, you do it systematically. It is systemic. You divide this by this, okay? What you get, multiply by what you have here, then plus 4%. So here you have 5.95. Therefore, my yield to maturity is 5.95 what percent. Now, so far we have seen bond valuation, okay, and we have compared the nexus, the link, okay, the what relationship between the bond yield and the bond price. We have also done how to determine the yield to maturity, which is the kernel, the basis, the fundamental of bond valuation. In my next video, I'll be showing you bond valuation using market spot yield and taking standard exam question. Please, the class has begun without any story. If you are waiting for a month of the exam, that is not too good. By then, I might be busy not to pay attention. But now, start your study now so that you can address your questions to me. And then I can give you adequate attention. See you in my next video. Thank you very much. God bless you.